Interfor announced that from September to December, they will reduce lumber production in North America.
I think the frustrating thing is that so much faith has been put in the relationship between Canada and the U.S. over the last number of years, and to see your best friend turn on you and create an economic crisis to try to hurt you.
One of the largest forestry companies in North America has just pulled back in a way that sends shockwaves across the border. Interfor announced it will cut lumber production by 145 million board feet between September and December. That is about 12% of its usual output, and the slowdown stretches across mills from Sault Ste. Marie to Elk Lake in Ontario. On the surface, it looks like a corporate adjustment to weak demand, but beneath it lies a political story, because the cutback is unfolding at the same time that U.S. tariffs on Canadian softwood lumber have been ratcheted higher. What was intended as a way to pressure Canada is now creating uncertainty for American builders who depend on this supply every single day. Interfor has explained that it is facing persistently weak market conditions and broad economic uncertainty. In late July and August, the U.S. Department of Commerce finalized anti-dumping and countervailing duties on Canadian lumber, pushing combined rates to between 20 and 34%. For exporters, these costs cut margins and discourage full production. At the ground level, the effects are clear. In Sault Ste. Marie, a third of workers were put on rotating schedules, collecting employment insurance for several weeks, while senior employees kept steady shifts. Families now live with unpredictable paychecks, a direct consequence of trade decisions at the border. The intention behind the tariffs was clear. By imposing heavy duties, Washington hoped to push Canada toward concessions in trade talks. But the outcome is not lining up with the plan. When a company like Interfor reduces supply, the direct result is less Canadian lumber flowing into the United States. That matters because U.S. construction has long leaned on Canadian imports. Roughly 3/4 of the softwood lumber used for home building south of the border comes from Canada. Already, futures markets reacted to the September announcement. Prices that had been sliding due to oversupply began to move upward again. Builders now face the prospect of higher costs for framing, roofing, and flooring. This is not a theoretical problem. Housing affordability in the U.S. is already stretched, and construction budgets for infrastructure projects are tight. By forcing supply cuts, the tariff policy risks making these challenges worse. The notion of punishing Canada begins to look like self-inflicted pain. Interfor's move is more than a corporate decision. It is a sign of how an industry adapts when tariffs make cross-border trade less viable. Instead of bending to U.S. pressure, Canadian producers are trimming output and exploring other markets, while Ottawa has stepped in with more than $1 billion Canadian dollars in sector support. The outcome is that American builders have fewer options, not more. Union leaders in Ontario warned that if Washington extends tariffs beyond softwood lumber to products like pulp or oriented strand board, Canada will be forced to escalate its response. That would set off a new round of retaliatory measures and deepen the divide between two economies that have long depended on each other. The lesson is straightforward. Tariffs on Canadian softwood lumber were designed to secure leverage. What they are delivering instead is rising volatility, fewer jobs on both sides of the border, and higher prices in the United States. The backfire is already visible, and it raises a deeper question. How long can Washington continue a strategy that undermines its own housing market while straining a trade relationship that has been central to North American growth for decades?
The fact that these conversations are happening is a good sign, right? I take note of the Prime Minister's comments that the bulk of their discussion, I'm paraphrasing, but the bulk of their discussion focuses now on the sectoral tariffs.
The trade standoff between Canada and the United States has many moving parts, but at its core lies one of the most important sectors in the Canadian economy, the auto industry. In the weeks since President Trump raised tariffs on Canadian goods outside of CUSMA from 25% to 35% on August 1st, the focus of negotiations has shifted directly to the hardest-hit sectors. That list includes steel, aluminum, copper, and most importantly, autos. Prime Minister Mark Carney has spoken with Trump twice in the past week. Officials in Ottawa describe the renewed conversations as a positive signal, because for weeks after the August deadline, there was silence. Now the question is whether these talks can translate into relief for industries like auto manufacturing, which sits at the center of Canada's economic and political landscape.
So we're looking now, given that we've got the best deal, to really focus in on those strategic sectors and prepare the groundwork for that broader discussion on CUSMA. That's what we're doing.
Autos are not just another export, they are a cornerstone of Canada's cross-border economy. According to Statistics Canada, Canada exported more than $412 billion worth of goods to the United States in 2024, and automobiles made up a large share of that total. Hundreds of thousands of Canadian jobs depend on assembly lines and part suppliers that are tightly integrated with factories in Michigan and Ohio. Tariffs on the metals that go into cars are already driving up costs. The 50% tariff on aluminum and steel that Washington imposed earlier this summer is squeezing the price of frames and chassis. The 35% tariff on non-CUSMA Canadian goods raises costs even further when components do not meet strict rules of origin. Mexico, meanwhile, has been granted a 90-day delay on new tariffs, creating another layer of competitive pressure. Canadian producers find themselves paying more while their rivals to the south face fewer immediate restrictions. The risk is not abstract. The Alliance for Automotive Innovation has warned that sustained tariffs could reduce U.S. sales and cut into Canada's export numbers as well. At home, the pressure is building. Economists point out that Canada's economy contracted by 0.4% in the second quarter of 2025, with exports to the United States showing the sharpest decline. Inflation is holding at 1.7% year over year, a manageable figure, but the weakness in growth adds urgency to the debate. Carney's challenge is to project steady leadership in front of Canadians while also responding quickly enough to prevent job losses in sectors like auto manufacturing. Commentators describe his approach as calm and capable, but they also caution that leadership must be proven with action. Canadians want more than words. They want to see policies that protect wages, keep factories running, and give certainty to workers whose livelihoods are on the line. This is why the upcoming fall budget is so critical. Carney has described it as both an austerity budget and an investment budget, a mix that sparked debate. On one side, fiscal discipline is needed to stabilize Canada's finances. On the other, investment must support industries facing immediate threats. The auto sector is at the top of that list. Federal initiatives from battery manufacturing to electric vehicle production could help protect jobs while tariffs remain in place. Critics argue the government has moved too slowly, but supporters point to steps such as the Major Projects Office in Alberta, created to speed investment. The test will come when Canadians see whether Ottawa can deliver tangible support for auto plants and suppliers. People already accept that Trump is unpredictable. What they expect is for their own government to shield industries from the fallout. If Ottawa can secure tariff relief or offset damage with targeted investment, confidence in Carney's leadership will grow. If not, the pressure of lost jobs and higher costs could quickly shift the political balance. Canada's auto industry now stands as the measure of whether calm leadership can be turned into results.
Tourism in Las Vegas is in a big slump this summer, costing the city billions of dollars. Some are saying that could signal trouble ahead for the U.S. economy.
This summer in Las Vegas tells a story that reaches far beyond the bright lights of the Strip. Crowds are smaller, hotel workers are bringing home half the tips they earned last year, and even simple purchases like a drink now leave visitors with sticker shock. The city reported an 11% drop in total visitors in June, according to local officials. For an economy that depends on constant traffic from tourists, that decline means billions of dollars lost. At the heart of this downturn lies a question that is echoing across America. Are President Donald Trump's tariffs and tougher border rules slowly choking the life out of U.S. tourism? The administration has leaned heavily on tariffs as a show of economic power. But those policies, along with stricter immigration enforcement, are now colliding with one of America's most visible industries.
Is Las Vegas dying, or is it all hype? it is dying. Not only with the tourism, but with the pricing. The consumer looks at it and says, man, I'm paying this much for this. I just don't see the value.
Las Vegas has become the clearest warning sign. The mayor has confirmed that the number of Canadian visitors flying into the city has collapsed by 40% so far this year. For a market that once supplied a steady stream of guests, the faucet has indeed slowed to a drip. That drop alone helps explain why casinos, restaurants, and shops are all feeling the squeeze. The pain shows up in everyday paychecks. Restaurant workers who used to earn between $150 and $200 a day in tips now see only $50 to $60. Tourists are still spending, but the crowds are thinner, and higher prices on hotels, meals, and drinks make people think twice about returning. Experts in Nevada are warning that Las Vegas cannot simply charge more to make up the difference. A city that built its reputation on offering value is losing the very appeal that made it unique.
I think since 2006, the number of people coming from the U.S. to Canada is more than the number of people crossing from Canada into the U.S.
The contrast becomes clearer when looking at what is happening across the border. Canada has faced the same tensions, with its citizens cutting back on trips south. Customs and Border Protection data shows 2.4 million land entries from Canada into the United States in July 2025. That was 500,000 fewer than the same month last year. The decline has been sharp enough to hurt duty-free shops along the border. The Frontier Duty-Free Association reports sales in July were still down nearly 37%. One store in New Brunswick even closed its doors after more than 40 years of business. Yet Canada itself is not standing still. For the first time since 2006, outside of the pandemic years, more Americans traveled north than Canadians traveled south. Statistics Canada confirms that in June and July, cross-border flows tilted in Canada's favor. Families, baseball fans, and summer travelers increasingly chose Canadian cities as their destination. Even with some struggles at border towns, Canada has managed to present itself as a stable and welcoming option. In this climate, Prime Minister Mark Carney's message of patience and openness is resonating not just with trade partners, but also with ordinary travelers. The lesson is clear. President Trump's tariffs were meant to project strength, yet their ripple effects are hurting American tourism. From the Strip in Las Vegas to border duty-free shops, the sector is losing visitors, especially Canadians who once came in steady numbers. At the same time, Canada is quietly turning the tide. More Americans are crossing north, and Canada's image as stable and welcoming is paying off. While Trump's approach makes the U.S. look less attractive, Canada gains simply by holding steady. In this contest, resilience is proving stronger than force. The real question is whether America can afford to keep driving travelers away while its neighbor turns caution into opportunity.